Good afternoon, everyone. Welcome to today's stream. Our first stream of 2021. My name is Stock Darts, and we're going to do what we normally do on Wednesdays. We're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the major market indices, we'll take a quick look at the US dollar. We'll look at oil, gold, and silver, and then we'll move on to chart requests. Anyone in here or anyone that jumps in, if you have a chart request that you want me to look at, feel free to type it into the chat, and I'll go ahead and take a look at it when we get a chance. If you're watching this as a recording, you can always ask me on Twitter. For those of you that maybe don't know, you can always follow me on Twitter at StockDarts. You could find me also on YouTube at StockDarts, or you could visit me at patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch list ideas, and just generally kind of expanding on some of the information we come across during these Wednesday market streams. Typically what I like to do is analyze what kind of market environment we're in during these streams, and then tailor my trading towards that. So if I feel like the market's range bound, then I'll look at more range bound strategies. I feel the market's breaking out, then I'll go ahead and take advantage of more aggressive directional swing trading. And vice versa, if I feel the market's correcting, we go ahead and adjust our stance compared to, to whatever is going to fit the needs of what the market is forcing upon us. Other than that, let's go ahead and get started. First thing I want to do is take a look at the S&P 500 through the ETF SPY. As you can see, we are actually having a very strong day today, and the market's pivoting on us. And this is something that is very interesting because we started off the week kind of poorly, and really started the year off poorly if you think about it. So the first trading day of the year was on Monday, and you can see we opened up slightly higher, almost at all-time highs, and then just sold pretty much the entire morning. Got a little bounce into the close, but for the most part was a pretty ugly day in the markets on Monday. And when you consider that it was the start of a new year, when you consider the way we finished last year, there was the potential for that to be the beginning of what could be a week or 2 week correction, or possibly even a month-long correction. And that has kind of changed with the action we've seen today. As you can see, and this is one of the things I wrote for those of you that maybe are that follow me on Patreon or read my Patreon posts. On Monday we were expecting a market that might actually be negative and would pull back on us. However, despite that, we knew that there was potential for the market to turn around and bounce. So we were still looking at directionally trading to the long side and taking bounce trades rather than getting panicked or worried about the market in general. And I think that's the key you want to take away with today's price action is, and I spoke at length with another trading friend of mine today, and he is also of the opinion that maybe the market is starting to drop a bit. And what you want to do in these situations is you might have a thought as to what the market's going to do. However, that doesn't mean that you want to go ahead and change your trading stance right away. Give me 1 second. Someone was at my door. Alright, I'm back. Amazon dropping off deliveries as usual. So, my train of thought here. We were talking about, alright, so when you have candles like the one we had on Monday, or this candle here possibly on December 21st, or even this candle here back in November 9th, it's just one candle, right? And even though it's a candle that can change the landscape of the market. So, for instance, we had a big candle that changed the market landscape here back in September. Now, this doesn't always turn into a correction, right? In September, it actually did turn into a minor correction where we dropped for a couple of weeks, maybe 3 weeks, and then eventually we're range bound and made our way back up. Sometimes it's just one candle that does nothing. It's just the signs of potential distribution, but it doesn't necessarily mean that the market's changing its character. And so when you have these scenarios like we had on Monday, you want to start thinking about what could possibly happen, but you don't want to immediately change your trading process until we see more proof that the market is changing its character or changing its behavior. And so we went ahead and looked at trading the normal trades that we've been taking over the last few weeks. And for now, that's profiting and is benefiting for us because the market ended up doing, what we, not necessarily what we expected to happen, but we knew was possible, which was that it could fake traders out and bounce. And at the moment, it looks like we're right back in the same scenario that we've been in for the last several weeks, which is a market that's kind of pushing to new highs. And you can see it on the S&P 500, but as we get to the Dow, and particularly as we get to IWM, as you can see here on my watch list here, IWM is up 4%, while the other indices are up, 1%, and the NASDAQ is unchanged. So what we have happening here is the same behavior that we had towards the end of the year, which was the small caps were outperforming and leading the way higher, which I think is, again, a good thing because it shows that traders are willing to accept risk, and it shows that money is flowing into some of these areas. Now, some of that is energy, and some of that is some of the small cap drillers and other areas because oil has been going up. But we'll get to that when we get to commodities. But generally speaking, small caps are starting to lead the way, and they're starting to improve, which, again, gives this rally more legs than maybe we're giving it credit for. Like I said, I was a little bit more hesitant as to how we were going to start the year, but what I'm thinking is going to happen doesn't mean I'm going to change the way I trade, because in the end, as a trader, you're not trading off of what you predict. You're trading off of what the market does, and you're reacting what the market does. And I think that's an important distinction to make for those of you that are in here, is when you trade, of course, part of the game of trading is you have to make predictions, right? You have to try to figure out what's going to happen, where a stock's going to go. But in truth, if you're the type of trader that trades the way I trade, using technical analysis, you might have a theory, or you might have a thesis as to what a stock's going to do, but in the end, you don't actually do anything until the trade triggers, until the trade tells you that something's going to happen. And so in the end, what we're really doing is reacting. So on Monday, even though I thought the market might drop, I also knew there was a chance that it could rebound. And if it does, then the trades I wanted to take were, and then those are the ones that I looked at, right? So that's how you want to go ahead and approach trading, and how you want to go ahead and try to take advantage or try to take your trades in a market that's kind of fluctuating back and forth a bit like it has over the last couple of weeks. Now, again, if you step back and really take a look at what's happening here, we're at all-time highs, right? We are still in a market that's kind of coming up. Now, we'll take our, most technical analysis is done with trend lines and moving averages, but I find that one of the tools I like to use a lot is the rectangle, right? So we take our rectangle tool. We can see that the market has actually been kind of range bound since really the beginning of December. And while we printed new highs, for the most part, we've been kind of stuck in a range between about 365 and really about 370. And then recently, it's been expanding all the way up to the 374, 375 range. So we're slowly making our way upwards, but we're really just kind of range bound, and we've been kind of stair-stepping upwards. So you might get the impression, well, we've been rallying since November, we've been rallying since October, the market's getting tired. But the truth is that the market has actually consolidated quite nicely without maybe people realizing that it has. And we're still at a point here where we can rally and we can bounce higher, and the market's not really that tired about it, right? You can see we've been testing the 20-pair moving average repeatedly throughout the second half of December to now, and are starting to make our way back above it. For those of you that have been following me throughout the last year, you'll know that as we started to move into the holidays, we noted that the moving averages were starting to shift into a stance that tells us there's a good chance the market's going to rally. When you see the 20-pair moving average start to climb up, you see the 50 turn up, and you see them spread out. That's usually a good sign that a rally's underway, right? And typically during these rallies, you'll have the 20 support price action, and eventually the 50 will support price action. But either way, as long as they're both in this sort of parallel track moving upwards, the market is much more likely to continue rallying than it is to turn range bound. So this is a sign that we're possibly going to continue making our way upwards, despite the fact that it's a new year and we feel like maybe the market's not ready for that. The market's telling us something different. And like I said, when you have a candle like we had on Monday and it's negated over the next couple of days, that usually tells you again that there's been a shakeout here and that the bulls are still firmly in control. So for now, we have to assume the bulls are in control, and we have to assume the market wants to continue going higher, and that's the way we need to approach our trades. So let's take a look at the levels on the S&P 500 and on SPY, and figure out what has to happen in order for this to change, right? So we have a new, we're going to zoom in here for this. So in the very, very short term, we have this level here, right? And this becomes our very short-term signal as to what the market wants to do, right? As long as the market stays above 370, the market's going to continue ramping up and rallying. If we lose 370, it's not the end of the world, but it tells us that the market's still stuck in that rectangle that I pointed out a little while ago, and is likely going to come back down and test 365. And then at that point, it's probably going to meet up with the 50-day moving average. And then we'll have to figure out at that point whether the market is going to find more buyers. It probably should, and then try to make its way back up. But we have our very short-term line in the sand here at around 368, which again is the low or the close from Monday, and then the open on Tuesday, and then today's lows. And this little three-candle pattern shows that buyers are defending the 20-day moving average and are defending this 368 area. And like I said, we've made our way back up, and we've breached the highs from Monday, and are really trying to make our way back up to this wick from the end of December, right before Christmas. So those are the two support levels that we need to concern ourselves with in the short term, is 368 and then 364. I don't think that at this point we need to worry about anything below that. With the buying that we saw in the last 2 days, this is probably the extreme of what we can expect, at least from here to next Wednesday and probably through the next couple of Wednesdays. Now, as far as upside's concerned, well, we're making our way back up to this wick, which is going to be the next key zone to kind of push through. But what we're doing right now is we're already kind of breaking past this area right around here, around 373. Now we do have something else, which is we have a little bit of a broadening wedge happening here where we're starting to slowly ascend. And it's going to be interesting to see what happens if this gets broken in the next couple of days, if we really accelerate to the upside and push past that. But chances are we're just going to come up the next couple of days, and really the key is going to be what happens when we challenge in this area. Right, so once we get to that area, then we'll see whether the market is really ready to continue ramping up or what's going to happen. So this is kind of the general roadmap for what you can expect out of the S&P 500 from here to Friday, and probably from here into the next couple of, Monday and Tuesday of next week, which is we're going to run up into this area probably in the next day or two. And then from there, we'll see whether we're ready to push past it or whether we're going to come back down and kind of ride this trend line between this trend line and the 20-day moving average. So again, I'll reappropriate another trend line. And so this is what the market's doing right now. And until things change, we can probably expect it to behave in a very similar pattern. So with the size of today's candle, I'm expecting tomorrow to be probably a more narrow range candle as it comes up into this area around 376 to 378, and see how it challenges it. Now, if we get another big green extension candle like we did today, well then, like I said, that means that we're blasting off and we're breaking out to new highs, and we should, as traders, adjust accordingly and start trading more momentum. And as long as you're not chasing stocks higher, you can take advantage of the momentum to the upside. And I think that's really the key here. So we had a market that faked us into thinking it's going to drop, right? However, it did not drop. In fact, it actually reversed and is starting to climb again. So what you want to do right now is not let the fear of missing out take hold of you, and you start chasing stocks that are at highs. There's still plenty of stocks that are at support or are just starting to break out of consolidation ranges, and that's what we want to go ahead and trade to the long side. You don't want to try to play a stock that is up 4% on the day and is running up into all-time highs or running up into resistance. Of course it could print higher tomorrow, but you don't have good risk reward at that point. So what you want to do is find stocks that give you, or are still giving you, or presenting good risk reward versus where they stand right now, rather than just saying, well, the market broke out, so I got to chase whatever I can. The year is young. The last thing you want to do is start off negative by not being disciplined with your trades. So that's what we're seeing on the S&P 500, or what I'm seeing on the S&P 500. Like I said, even though my thoughts initially to start the year were that we might be correcting, at this point the market's not showing that, and in fact it's showing the opposite. And so we kind of have to roll with the punches and just follow the market where it wants to go. If you, like me, are a little bit worried about this market and you think that there's a chance that we sell off into the next month or two, well, we have our first warning signals, which are, again, this 368 area, which is the very short-term warning signal, and then the more important warning signal right around 364, which will probably coincide with the 50-day moving average once price gets to that area. Now, if we lose that, then we're going to head back into this area around the 355 to 352 range, which were the highs from September to October. And we'll worry about that when we get to that. But that would be the next level that you need to concern yourself with. But even if we drop to that, even if we drop to the 340s, generally speaking, we're still in a very strong market environment. And so this is the other thing I wanted to point out is even if you're worried about the market, there's a lot of room here for this market to drop and for it to still be in a very strong bull market. Now, does this mean you should ignore stops? No, quite the opposite. You still want to respect your stops, because this market could blow you completely out of the water and still be in a bull market. So you don't want to just ignore stops. However, what this means is even if we get a strong correction in the next month or next 2 months, it's probably going to be a buying opportunity, not necessarily the nail in the coffin for our rally. We have covered so much ground, particularly since March, and we've broken through so many different levels of resistance that at this point it's pretty clear that the market wants to go higher. And if we do get a correction, we're going to probably need multiple corrections before we go ahead and negate this bull rally. Unless we get another black swan event like we had in March, we can expect whatever correction we have to take place over several legs, which means we'll have ample opportunity to switch our stance if that were to occur. However, I would imagine if whenever we do get some real selling pressure, that it's going to be a buying opportunity, not necessarily the end of whatever rally we are in right now. All right, so let's take a quick look at the NASDAQ, which, interestingly enough, is the weakest of the four major market indices as of today. You can see it is doing the same thing as the S&P 500, which is finding support at the 20-day moving average. It is trying to bounce, and it is. However, it's not at all-time highs, and it's still kind of struggling with these the closing price from Monday and the open from yesterday. Now, it's above it, so it is, like I said, performing decently well compared to where it's been. But when you compare it to the other indices that are up 1.3, 1.8, and 4.6%, this one technically is down from yesterday's close. And what this means is that the big FANG stocks are kind of stuck in neutral today. A lot of big tech stocks are kind of struggling a bit. The only pocket of strength really in tech that I've seen recently is semiconductors. But a lot of these other tech names are a little sluggish. But again, not necessarily in any kind of bear market or any kind of real negative area. They just are slow compared to what we're seeing in the Dow and IWM. And I think this was to be expected. This is something that we've seen. We've seen a transition from tech to some of these other areas of the market over the last few months. And a big part of that is really, these other names have been beaten down all year while tech has outperformed all year, or at least through all of 2020. And so we're starting to see a shift in that. And that's to be expected, particularly when we have a vaccine rolling out. We have the hopes of our economy opening up a bit more. So a lot of these areas that were struggling are starting to recover on the expectation that they will start to get more business coming in soon. And conversely, all these stocks that have benefited, and a lot of the tech names that have benefited from us being quarantined, are, I don't think, in a bad place. I think they're still in very good shape. But they are definitely, at this point, I'd say a little bit tired. And people are taking some profits because they've just moved up so much over the last year. So that's kind of where we stand with the NASDAQ and one of the issues that we have with it. Now, if we look at the levels on the NASDAQ again, it's still in a good spot, right? So we have this high from September, and as you can see, you follow the dotted line, we're still above that, and we've actually, our little consolidation range that we've had since December has stayed kind of above that. So the market and the NASDAQ is still holding strong compared to its past reference points, right? So we're still above most of 2020's price action, and we're really just kind of holding up and starting the new year very close to all-time highs. And again, like I said, if you look at the alignment of the moving averages, it's looking good, right? The 20s climbing, the 50s climbing, the 200s climbing. Everything is still showing signs of a market whose momentum is carrying it upwards, not a market that's slowing down or ready to trade sideways. Now, this can change, of course, but at the moment it's not changing. Now, if it does change, what will be the warning signs, right? So, as you can see, we're going to draw a little line here. We're going to move it down. Oh. Alright, so as you can see, we're having this process of previous highs or previous resistance becoming support, right? So we had it over here where this high became support, and then these highs from the 8th of December and the 9th of December turned into support as we kind of made our way through the middle of December and into the holidays, right? And so as you can see, this is what's happening right now, is we're coming back and we're retesting what was resistance and what turned into support, and we're confirming that this is still support. So for those of you that maybe don't understand this from the psychology of the market, what's happening here is the market is coming to a decision as to what is a good value on an equity and what is not good value, right? And so what ends up happening is when the NASDAQ hit this 30200, or basically 300 in September, it was considered overpriced, right? And so immediately there's sellers that come in and push the market right, or push the NASDAQ right back down. It comes up again, falls just short of 300. So this area is considered not a good value. What's considered a good value during this time is the 265, 267 area, right? And this is something that happens throughout the market process, right? Comes up again, falters at the same exact level, just below 300, so it's not considered a good value. Now, eventually what happens is there's a change in the thought process of buyers and the market in general, and they decide all of a sudden, well, we have enough buyers to overcome this selling pressure, and when they do that, then there's a new consensus that takes place where now all of a sudden this area that was considered overvalued is now considered a value. And so now the market is trading over 300 because it's considered a good price, while it was considered a poor price back in September because of the change in economy, or the change in traders' perception of what the stock is worth. It changes, and now that becomes the level of value where traders think that it's worth buying. And so this process happens over and over. And so what we've gotten to now is where it's occurring again in the 308 area, where traders are kind of confirming, you know what, this is still good value. And so as of Monday, it looked like maybe traders were thinking, you know what, we were wrong. We've got new Democrats coming into office. We've got all kinds of stuff that might push the market back down. We've got problems with the vaccine, and the market drops, right? But what happens over the next couple of days is people are like, wait, no, this is still a good value. And so they buy over the next couple of days. And so that's where we stand right now, and until that changes, we have to assume that the market is in the same state of mind that it's been since really October, since we broke out from the most recent 2-week correction or so that happened when we dropped from about 296 down to this 268 area. And so since then we've been rallying, and the market has continued to push upwards, and so we are under the assumption that it will continue to do so until things change. And when do things change? When we start to lose these levels, right? When we lose that consensus on what value is. And so for now, the value area is 308. If we lose that, we're going to come back and test what is a more important value area, which is this area from 300 to 297. And that is the critical test. And assuming that it holds, which it should, because it'll be the first real strong retest of that and the first test of the 50, it should be a buying opportunity which propels the market to come back and retest this area. Now, the other side of that coin is, it could be that we've already tested and said this is fine, and we break out to new highs over the next couple of days, and we follow suit with what's happening with IW and the Dow Jones. And so we're going to move on to the Dow in a second, but that's where we stand. And like I said, the key area in the very short term is 307 to 306. The more important area is this 297 to 300. And like I said, I don't think we lose this from here next Wednesday. So it doesn't really mean we don't really need to spend a lot of time looking at the next level. But just so you know, the next level is going to be somewhere around 285, 286. And then obviously to the highs, we need to break Monday's highs if we want to rally and follow what we're seeing on the Dow and IWM. So here's a look at the Dow. You can see a massive breakout underway, right? And so this is where we get a better tell as to what the market wants to do. When we get to the Dow and we get to IWM. Now, like I said, there's been a rotation game that's been happening recently, and it really was happening throughout December, where a lot of the Dow components, a lot of IWM components that were struggling are picking up, and they're starting to heat up, and they're starting to do better. And with that, we're starting to see that they're taking a leadership role in the market, rather than the Qs and the NASDAQ and the FANG stocks, which have been kind of leading the way throughout 2020. And this is important for us to realize as traders, because this is where the strength is. This is where we want to go ahead and try to find good trades, is some of these components that are picking up steam and are starting to do better, right? And so you might be wondering, well, what do how do you find this? What are you looking at? Like, where do you find these stocks that are behaving better, the components of the Dow and components of IWM? Well, one of the things you can always do is you come over here to finviz.com, right? This is another free website. You don't have to pay anything to use it. If you go to just the front page, it gives you whatever stocks are up the most on the day. Now, this is sometimes fool's gold because some of these are very low gainers or they've gapped up for whatever reason. However, you can always just go here to the maps, right? You go to the heat map and you get an idea of what's happening for today. So you can see everything. Now, of course, a day like today, everything's green, right? But you can always come over here and you can change it. What's been doing good over the last week, right? Or you could look at what's been doing good over the last month, right? And you get a better idea of where the strength in the market is, right? And as you can see, it's still been, tech names have still been very strong despite the weakness we've seen over the last couple of days. You can see the finances, a lot of banks have done well. You can see some nice pocket of strength in energy. There are pockets of strength everywhere because the market has been in a strong rally. But you can keep going and you can keep looking and try to really gauge where the strength is. Now, of course, lots going to be green because the market has been in a very strong rally throughout the last couple months, right, or 3 months, and so that's why everything's green. However, you can also go here to groups. You go to groups, then you can see relative to each other what has performed the best. So you can see what's doing well today: basic materials, finances, energy, industrials. What's done good over the last week? Basic materials, energy, finance, industrials. What's done good over the last month? Basic materials, finance, then consumer cyclicals, which jumps in that maybe we didn't realize, but energy picking up steam as well. Same thing, 3 months: energy, basic materials, finance, industrials, right? So this is exactly the rotation that we're seeing with the Dow Jones and with IWM and where the money is flowing. And you can go in here and take a look at that. Then from there, you can always go to the screener, and then you can just go by the sectors, right? And you can try to figure out basic materials, which ones are doing well. Then you could screen for, obviously there's 241 stocks right now, so you'd have to go ahead and change things to see what you'd want to see, right? Whether you want to look at a certain value price, whether you want to look at how it's behaving. There's all kinds of different indicators that you could use to really figure out what you want. But you can go in there and then take a closer look at what it is that you want to figure out, whether it's through performance or whether it's through fundamentals, whether it's just volume, making sure that you're getting a stock that's trading over a certain threshold, so you're not in any small caps or low float stocks, something like that. But that's how you go ahead and kind of weed out and figure out what is doing well. So, from the top down, when we're looking at these, we're looking at the market indices, we're figuring out what the market is doing. But as you drill down lower, you have to go in and kind of be like a detective and try to figure out where money's rotating and what stocks are doing well. And you also kind of want to get in front of it a little bit, right? So, energy has done well for 3 months, basic materials. At this point, you would have to go in and make sure that those stocks still have room to keep continuing, or whether there's going to be more rotation. Now, like I said, it looks like we're starting to get that rotation again, so a lot of those stocks are going to outperform, so that's where we want to look. But you want to make sure that you kind of stay ahead of it, and you realize when they start to get tired, and you start paying attention to where money rotates back and forth. So at a certain point, the Dow and IWM, they'll start to get tired, and the Qs will pick up a little bit of steam, and the money rotate back into them. And so you start looking at tech names again. You look at semiconductors, you look at some of the network names, you look at stuff like Netflix. You go back and forth between them. And so that's how you kind of, when a market is range bound, like maybe it was over the last couple of months, where it's slowly making its way up, but it's kind of just staying stuck in a range. Well, what's happening is it's just rotating back and forth, and there's different stocks taking turns rallying. And so the market as a whole is, not necessarily stuck in neutral, but slowly climbing. But then generally speaking, there's still stocks that are going up and down because money's rotating back and forth. And then eventually you get the blast off like you have today. So like I said, when you have a candle, we'll do this little move here. When you have this, right? So this looks like a change in character in the market, right? We had a market that's slowly climbing up, and it's kind of stuck in neutral, where it's really struggling to push to new highs, right? And we get a gap to new highs, and then we get a huge fade. And even though it closed back above the 20, that was a warning signal that the market was ready to pull back. However, it ended up being a fake out, right? Because the next two candles show that there's a lot of buyers and there's still a lot of bullish momentum in the stock market. When you have this happen, you realize you want to be to the long side, right? So that's what we want to do. We want to look at Dow components. We want to look at IWM components and go from there. Now, what would change my mind on this? Well, on the Dow, you're going to have to see a break back below recent highs. So unlike the others, where the first line in the sand is the lows from Monday and from yesterday, with this one, we're looking at the highs, right? Because we've already had a big breakout. So we don't want this to be, just like we had a false breakdown on Monday, we don't want a false breakout today. And then we just have a market that's volatile and just chopping back and forth, right? So we need this breakout to hold if we are under the opinion that the market is going to rally and that we want to take advantage of a new leg up in this rally. So in this particular case with the Dow, we don't want the stock, or we don't want the Dow or DIA to trade back below 306.50 or so. And so these are the highs from Friday or Thursday and from Monday. If we do lose those, then we want to stay above the 20 period, and we want to stay above this, right? So as you can see, our two levels of support are a little bit ahead of what we're seeing on the SPY and the NASDAQ. Now, like the other two, notice the 20-day moving average, notice the 50, notice the space between them, which is, again, this is a good sign of an accelerating trend and a trend that's moving upwards. We could probably change this trend line to this right now. And so this is what we have going, right? We can also do this. And you can see, again, we have an acceleration in trend here. We're breaking out of this channel or this wedge that was being traded. Now, typically, this usually doesn't last a long time. When you have an equity that's moving up and then it accelerates above it. However, in this particular case, because, again, like I said, even though the markets were slowly inching upwards in December, they were kind of range bound, so there is momentum to be had here. This isn't a tired market right now, so there is a chance that what we have here is we kind of have an acceleration where we switch gears and trade a little bit higher and just ride the ceiling trend line, and that becomes a new floor. But again, we'll see what happens on tomorrow's price action, and whether we start to flag or whether we do have another extension above that, or whether we give it all back. Now again, I don't think we give it all back because of the way we changed already, but we'll wait and see. But I think overall, again, like I said, this is a very good breakout, and this is showing that the market wants to rally further. And until we see a change in character, we have to assume it wants to continue making its way upwards, which means it's going to leave this price action behind and establish some new price action above it. So that's basically the Dow Jones. Like I said, we should not expect price action to fall below 300. And if it does, I doubt it falls below 298 unless some really drastic bad news pops up, and which I don't really see coming right now. But of course, you never really do. But unless something really drastic happens, we should not see the price action below this area from here to next Wednesday, or probably even the next couple of weeks. Now, the last index is IWM. The Russell 2000. And as you can see, we've got a runaway gap here. So this is even stronger than what we're seeing in the Dow Jones. We had our test of the 20-day moving average. We had Monday's candle, which again was threatening was threatening to move right now. So here's what's interesting. We had IWM, which was slowly making its way up and making new highs every day throughout December. So this shows you, again, when you look at this and contrast it to what we saw in the SPY, what we saw in the Qs, what we saw in the Dow Jones, there's no rectangle here, right? This has been slowly climbing basically throughout November and December, throughout the entire holiday season. Now, as we closed out the year, there was rotation away from IWM, and it was temporary. And this was apparently just profit taking, but at the moment it looked like maybe it was a shifting character in the market. You can see it was starting to lose its trend. We had these two red days on the 28th and the 29th. Now, if we look at the SPY, we look at what happened on the 28th and the 29th, you can see it was basically just small doji candles, right? You look at the NASDAQ, the 28th and the 29th, were basically doji candles at all-time highs, right? Meanwhile, IWM was correcting. So this was profit-taking, and this was a minor rotation back into some of the bigger names in the SPY and the Qs and out of IWM. What we're seeing now is rotation back into IWM, right? So this is what I was saying before about how at the moment this is not a tired trade. We already had some profit taking. We had a little bit of rotation outside of this area, and now it's rotating back in, looking for more returns and looking for growth, right? So what we're seeing here is the beginning of a move, not the end of a move, or at least that's what it looks like, right? Of course, I could be wrong, but that's what it looks like to me. We had this consolidation, we had this temporary correction, and now we have the breakout above it. Now, the one problem we have, of course, is how do you trade this, right? What are we up? 5% just on the day, closer to 7, 8, almost 9% over the last 3 or 4 days, right? So you don't want to chase this. What you want to do is find stocks that are beginning to break out like this, but aren't up, 4 or 5%, 8, 9, 10%, 15. You don't want stocks that are up 10, 15 points. You want stocks that are beginning to break out and are mimicking this and doing the same sort of patterns. So you want to look at small caps, you want to look at energy names, you want to look at basic materials, whatever it is that had the same pullback and the same correction at the end of the year and is beginning to take part of this rally and go from there, right? Now, what are the levels? What's important? So just like we said with the Dow Jones, the first key is we want to watch our previous highs, right? Which is basically the lows of today. We don't want to break back below that. If we break below that, then this is a false breakdown or false breakout, and that's probably a bad sign, right? When you consider that we had a breakdown or false breakdown, and actually in this case we already had two potential beginnings of a breakdown which didn't happen. So twice sellers were caught off guard and the buyers took control, right? If the sellers took control again, then they would likely blow past this entire area around 193, 192. So with IWM, we don't want to see it break back below 199, 200. We want to see it stay above that and confirm this breakout. If it does lose this, there's a very good chance that we're making our way all the way back down to 193 and probably going to break down through past that as well. So if you're worried about the market, you want your warning signal, you want your canary in the coal mine that's going to tell you when there's trouble, I would say IWM is what you want to look at, because this is the index that's leading higher, and if we're going to have problems in the market, it's going to be based off of a failure here. So if we lose 199 and we head back into this area in the mid 190s, that would be the first warning signal that this rally is probably dead, and we're going to either stay stuck in neutral and more range bound, or we're actually going to correct. So that would be what I would want to watch if I was worried about the market. Like I said, with today's price action, I'm not nearly as worried or as hesitant as I was maybe on Monday. And so, you got to kind of roll with the punches and do what the market tells you. And like I said, the market right now is telling us it wants to go up. It's not telling us it wants to go down. And so this will be the level that we want to watch if we're concerned with what the market's going to do next. Now, like I said, if we lose 199, the next key level is right around 192, 193. If we lose that, it's probably going to be the 50-day moving average that comes up to meet price, particularly on a strong equity like what we're seeing with IWM right now. Usually when you have a stock or an index or anything trading this strongly, the moving averages are the first place that you really come back and test, because you leave all these horizontal levels behind so far. It takes a long time to get back and test them. All right, so that's the four market indices in a nutshell. Like I said, Monday looked a little negative, but with what we're seeing today, what we saw yesterday, it looks like the buyers are back in control. And at the moment, I'm more inclined to go ahead and trade more long and more aggressively than maybe I was at the end of the year or at the start of this year. And so we're going to go ahead and ride this wave until it crashes, and then go from there, right? And so that's what we want to do. Like I said, you want to be disciplined. You don't want to chase price action. You want to make sure that you follow your rules, because like I said, IWM right now, it's at 205. It could drop all the way to 182 and still be in a bull trend. And still be firmly in a bull trend, right? Because if you look at where the price action is, most of last year it was spending below 158. You know, 20, 30 points would be enough to really hurt a trader's capital or hurt his portfolio, but it wouldn't do anything to IWM as far as where the price action is right now. So you want to make sure that you are disciplined and that you don't get greedy and you don't get lax with your judgment just because the market's going up. When we have a market like this, it erases a lot of mistakes, and it makes it easy for you to kind of ignore rules, because usually the market corrects it for you. But this doesn't always happen, and when the market shifts to neutral, even small changes like this put a lot of undisciplined traders into a lot of trouble, because they're just not ready for a 3 or 4 day correction, because it hasn't happened in a month or 2 months. And so they get spoiled and think that it's going to happen every day, and then 1 or 2 days of down, and all of a sudden they're taking these big losses they didn't expect. So make sure that you're disciplined, but make sure you're aggressive and take advantage of the price action we're seeing right now. Let's take a quick look at the US dollar. We'll look at oil, gold, silver. We'll take a quick look at Bitcoin, because I think, like I said, you know, we've been harping over the last month, that is an important area for traders to start really paying attention to, because the gains you get on that are much bigger than you can get on a lot of stocks. All right, so here's the UUP index. The US dollar is just in a free fall. There's no better way. There's really nothing else we can say about it. It's just slowly just dropping. It just doesn't have any potential bounce right now. It's trying to bounce again, and it's not really doing a good job of it. We look at the weekly chart, and we see what we're doing, and we are actually coming up. Let's go to the monthly, actually. We are coming up into a pretty decent level here. Level that we haven't really visited since back in the March of 2016, 2017, somewhere in this area. It's been a long time since we've come back to this level. This is serious dollar weakness that we're seeing as we start the new year. It should find support here, but doesn't mean it will, right? It hasn't yet. We would need to see it break this downtrend. We need to see it get back above the 20 before we could start to trust any kind of bounce on the US dollar. The reason we look at this again, the stock market, gold, oil, Bitcoin, it's all priced in dollars, right? So they have kind of loose inverse correlations, sometimes more strong than others. When the dollar is weak like this, everything else is going to rise, because the value of the dollar is eroding, right? However, you do need the dollar to have some strength, or else you lose all confidence in it and anything that's priced in it. So we don't want the dollar to just keep dropping, despite the fact that it's kind of propping up the market and propping up Bitcoin and gold and all that stuff, right? Not happening right now, but you know, the dollar at this point should find some support, and if it does, that should slow down some of the growth in some of these other areas. Or it could not. It could actually, you know, like I said, sometimes you want the dollar to be strong to have confidence in it. But as far as particularly with the gold and the commodity trades, they want the dollar to keep dropping. And if so, then they'll keep doing well. Now, gold and silver actually have had an ugly day today, which is interesting because, like I said, you look at UUP, you look at the US dollar, it hasn't done much. But we'll get to them in a second. Let's take a look at some of these individual currency crosses that we pay attention to with the US dollar. You can see the euro is gaining traction versus the US dollar. Now again, in this particular case, up is good for the euro and bad for the dollar, right? So you can see the US dollar struggling. It's in a free fall, and a lot of that is due to euro strength. Or the euro strength is due to US dollar weakness, either way. And you can see that it's starting to break out again today. If that continues, it's more weakness for the dollar. The dollar needs to put up a fight here, 123, and get the euro to pull back a bit. If we look at the US dollar versus the Canadian, you see the US dollar tanking against the Canadian as well. And this is going to be good for oil because that's one of the big trades between US and Canada. And again, you can see the US dollar struggling right at lows. No real signs of bouncing yet. And then the last one we want to look at is the US yen. And in this particular case, okay, the dollar has one green candle here, but it's just trying to recover and bounce off of a recent breakdown. So what can we take from this? The US dollar is still dropping. It's still struggling. It needs to change its act at some point soon, but it hasn't done so. So it's trending down, and we have to assume it's going to continue trending down until it actually changes. Interestingly enough, that should be good for gold and silver, and gold and silver have actually had very strong runs over the last few weeks. However, they're really struggling today, which is very odd when you consider the fact that the US dollar is not bouncing. But gold and silver have dropped kind of big today. And so this is there's been a disconnect between the dollar and gold and silver over the last few months. And for the life of me, I can't figure out what it is. But it is what it is. And what we're seeing right now, again, is gold and silver kind of doing their own thing. And on the bright side, they did find support, and they did make their way back into their previous range. However, you can see it wasn't able to break out. GLD wasn't able to break past, and what we're going to do here is I'm going to highlight basically what it's done, right? And so there is this range where this was, and I know it's not quite a clear picture. You could say something like this is probably a clear picture of what it's doing. We want to use the trend lines, but you can see that there's another level here that's pretty important. Right around 183, right? Which, as you can see, that was, kind of a point of contention when it was in this triangle. And twice now we've gapped to this level of 183 and failed. But we're gonna to keep it clean, we're gonna say it's doing something like this, and we'll say 180 to about 170 is the range it's been stuck in, and it's trying to break past that, and we're falling right back into that range today. So what we want right now is we want gold and silver to be done with this range, and to start really challenging this really small kind of intermediate range. And if that's the case, it should hold support here and kind of stay between 183 and about 180. It's not doing it yet, but that's kind of what you want to see if you're a gold or a silver bull. If we look at SLV, we'll see a little bit of a different picture. Silver actually did move through all that and is kind of just challenging this range that it's been stuck in from before. So relatively speaking, silver has been stronger than gold over the last few months, and it's actually in a nice little channel here, although these are the kind of channels that are hard to sustain for long term. But you can probably trade SLV along these lines, although there's not a lot of movement here between about 25 and 25.50, 25.60. So it's trading in a range, but it's not a very volatile range, and we'll see what it does from there. But as you can see, gold and silver, they're not quite doing what the US dollar is doing, right? They are rallying a bit, but they haven't had the explosive rally you would have expected with the weakness we're seeing in the US dollar. Now, on the opposite end of that, oil actually has been rallying pretty strongly, and it has climbed pretty steadily from 44, and it's finally hitting $50, right? And so the question now becomes, what is oil going to do next? Is oil going to start to range and start to trade sideways as it establishes a new range above? And as you can see, we're going to scroll back out. We'll go all the way up to the death candle from way back earlier in the year. We don't want to break the chart, so we can't go past that right now. But as you can see, oil was range bound between about 43 and about 35 for most of 2020. right? And it only started to really expand past that as we approach the holidays. It's in a nice rally right now. However, it will find resistance in the near future. Um, and at that point, it will probably establish a new rectangle we could draw. And it'll start trading sideways between, whether it's 50 and 45 or 50 and 40. But it will start to trade sideways. But at the moment, oil has actually been doing really well. And this is why some of those energy names also have done really well. Well, we've gone ahead and we were looking at the screener earlier, is because oil is starting to ramp up. And again, this is because the economy and the market is anticipating more energy demand as we open up our economy and start to get back to work and start to go out and shop and travel and all that good stuff. It's anticipating that we're going to need more energy. We're going to demand more oil, and that's why prices starting to go up, is in anticipation of that. However, at a certain point, we'll reach a ceiling where oil is, the price is not really, we're not ready to push past that. So we haven't hit it yet. It's going to either be 50 or it's going to be somewhere in the 52, 53 range, and we'll see what happens. But for now, again, oil is starting to ramp up a bit. Now, the last pseudo commodity we want to look at is Bitcoin. I understand a lot of people don't trust Bitcoin. They don't know what it is, or they don't think it's real. But whatever your thoughts of something is, whether it's a stock, so let's change gears for a second. Let's look at Tesla. Tesla's been, this is a stock that there's a lot of, there's a lot of contentious problems or traders with it. There's a lot of people that hate Tesla. They think it's a company that's not really worth what it's valued at. Let me get rid of some of these. Let me get rid of some of these trend lines. I don't know how they. This shows you just how explosive Tesla is. The chart. Some of my trend lines have just kind of floating in the middle of nowhere. All right, so a lot of people don't believe in Tesla as a company, right? And so they think the stock sucks, and they always try to short it, and they're always wrong. And this stock just continues to climb up and continues to print money for whoever owns it, right? Well, the same thing is happening with Bitcoin and Ethereum and Litecoin and all these other cryptocurrencies, particularly the major ones. They've just, look at this. You look at the run Tesla had, and this one's gone from 8,000 or 9,000 all the way up to 35,000. Just in the last month, it's gone from 20,000 to $15,000 just from December. And you can go all the way back, and you're looking at $25,000 just in the last couple of months. If you are someone that trades, you should not ignore this. This is a massive amount of profit that you can be making, whether it's trading that one, whether it's trading the Ethereum. You could tell yourself, yeah, but I don't have $1,000 to buy one coin, or I don't have $35,000. You don't need to. You could buy fractions of this, just like you could buy smaller amounts of shares of companies, right? You don't need to buy 100 shares of Amazon. You could buy one. It's the same with Bitcoin. You don't need to buy a whole Bitcoin. You could just put $1,000 into it, and then you would have already made yourself another $1,000, another $1,500, $2,000 just in the last month. So, if you're a trader and you use technical analysis, you could trade this. You could trade the Euro US dollar. You could trade Tesla. You could trade Ethereum. You could trade any of these things as long as you could fund an account with money and take these trades. And look at what Ethereum just did from 750 all the way to 1200. You don't get stocks that move like this very often. Now, of course, there's volatility in both directions. That's why you need to make sure you trade using technical analysis, using the right rigorous discipline that you would use for a normal stock trade. But you don't want to ignore this. And again, this is a big. If you're wondering with the dollar weakness, where's this money going? A lot of it is going here. A lot of it is going to Bitcoin. A lot of it is going to Ethereum. Litecoin hasn't been quite as strong, but a lot of it is going to Litecoin. These cryptocurrencies. This is where a lot of capital is rotating as the dollar continues to weaken and drop. And while I don't think it's the whole picture, I think this is part of the picture. While gold and silver aren't outperforming as much as they should, is because there's a new generation of traders and investors that trust Bitcoin and Ethereum more than they trust gold and silver. And so a lot of money is rotating here, and the bigger institutions are trying to play catch up and get to the same place. All right, so make sure you pay attention to that. Is all I'm saying. All right, so that covers it as far as what I wanted to discuss today. If those of you that are in here, if you have a stock you want me to look at, feel free to type it into the chat, and we have a little bit of time. We can go ahead and take a look at that. Um, you guys want to look at what we were looking at this week. Um, so like on my blog post, we were looking at a couple of stocks like LULU. You can see again, what I look for is support, right? We want to find a trend. We want to find a stock that's consolidating and bouncing off support. As you can see, Lululemon since Monday has actually had a nice little move, and it's up. It's not a huge trade for us yet, but it's starting to work in our favor. And so this is one of the ones we were looking at this week. Another one we were looking at, which is a little bit stuck in quicksand right now, is NVDA. It had a really nice move to start, but it's really struggling today. And then the last one we were looking at was CHWY, which also is doing pretty decent for us as far as the last couple of days. And so as you can see, the stocks that I was looking at on Monday and the stocks that I'm looking at over the last couple of days, they're not. I'm not chasing price action to highs. I'm looking for stocks that are at support, are testing support, are coming out of consolidation ranges, and sometimes they work, sometimes they don't. But at this point, the risk reward is what we're concerned with. And as long as you manage your risk reward, in the long run, the trades that work are going to cancel out the trades that don't work. All right. So like I said, that covers it for today. If anyone has a chart that they want me to add or look at, feel free. If not, we'll wrap it up. Those of you that are in here, if you don't feel comfortable asking for a chart request here, you can always just ask me on Twitter. I could DM it to you if you'd prefer that way, if you don't want to have it in public. Or you could find me on Discord, and you could message me on there as well. I'd be more than happy to answer your questions there. Or like I said, you could just ask me on Twitter. Again, my handle on Twitter is @StockDarts. And, more than happy to have any kind of conversation with you guys. Other than that, if you like what you saw here today, again, you could visit me at patreon.com/StockDarts, where, like I said, I post weekly blog content as well as reposting the recordings of these Wednesday market streams. Hope you guys have a good rest of this week, and good luck with the start of the new year. I'll see you guys again next Wednesday.